Here we are, we're full-blown risk-on mode in these markets. Spreads are behaved, equities are flying, and the dollar is up for 6 weeks in a row. In this kind of row and rates readjustment narrative, does dollar strength endure? Good morning, Mr. Gallo.
Good morning. Thank you for having me on the show. I think that the dollar story is probably overall less negative than what we were thinking at the start of the year. That's partly to do with the U.S. growth trajectory, and it's partly to do with the fact that the markets are now coming to the realization that the Federal Reserve has the luxury of being able to wait to lower the policy rate. We're looking at the May to July period for the first interest rate, 25 basis points from the Fed to come. In my personal opinion, May and June seems perfectly reasonable, but it could be between May and July. And I would say still, based on what's currently priced in for the Fed in terms of cuts for the full year, it's a little bit rich, just a little bit rich. Having said that, I think what we are starting to see in terms of the performance of the U.S. economy is more evidence of disinflationary growth. So Jerome Powell and the Fed and the U.S. economy right now, based on the real data and some of the survey-based data, are in a pretty good spot. It's the other economies that I think are in a little bit of a more worrying spot.
Well, Stephen, to that point, you write that central banks with stagnating real economies, the danger is that they're unable to ease policy because they have to defend their currency while the Fed is starting to ease. Can I be clear? Are you just talking about the UK there?
No, not at all. I think I think that because the dollar is the benchmark currency, it's the numeraire for the global monetary system, and a bad situation for the global economy, which is not it's a non-zero probability. It's not our base case, but a bad situation for the global economy would be that the Fed is unable to ease early, certainly not as early as perhaps the market's priced in, but it's not able to ease early whilst other central banks are forced with this difficult decision. We've got a stagnating economy, but we've got above target inflation, and we think we need to head off a deepening downturn. Do we ease and deal with the currency impact at the same time? Or do we ride it out with the policy rate where it is? So that is a difficult situation. It's not something I would say is off the table, but it's not the base case at the current stance. But what I would say is, for example, if you look at, in particular, the euro area seems to have a bad form of disinflation. Because of the tightening of credit conditions, because of the rise in bank funding costs, refinancing that took place in 2023. Some of that carries over, I think, into this year. It has a bad form of disinflation, or semi-bad form of disinflation. So if anything, I would say the risks are skewed to, and I don't think this is not shocking. It shouldn't be shocking to anyone, but I think the risks are skewed to the European central banks, including the BOE, easing before the Fed.
So, Stephen, if the Eurozone has, as you call it, perhaps a more malevolent form of disinflation, let's square off at home in the UK. I mean, the market there has repriced. If you think the Fed repricing has shaved about the market has shaved about 50 basis points off the Fed, but it has shaved 75 basis points off the cuts that they can expect from the Bank of England. So in other words, we're looking at 75 basis points for the rest of the year from the BOE versus 150 from the US. So what does that say about the Bank of England's capacity to cut rates? What's the market's assumption there? And what does that put a floor on sterling if we translate it into FX?
Not necessarily a floor on sterling.
Okay.
I would say that in terms of cable, I think you still want to be, the 127, 128 range in cable. I still think you want to be selling sterling there. You want to be buying dollars in that range because the structural outlook for the UK isn't particularly good. There are potential fiscal risks associated with the general election, but there's still a little bit of uncertainty related to that so far. But I think broadly speaking, the situation you described, Manis, is where the market is grappling with this issue of our star. Where is the new neutral nominal rate of interest? If the real neutral rate of interest hasn't changed a whole lot, you could argue maybe it has, maybe it hasn't. But if it hasn't changed a whole lot, which is my base case, but where is the neutral nominal rate of interest? Right. And I think that the market is grappling with where that is for the UK, for the US, for the euro area, and probably it's going to be a bit higher than.
Yeah, Manis, this was the new equilibrium that you were talking about, and how do we adjust to that world? Stephen, the other world we have to adjust to is politics. JP Morgan was out with a note on Friday saying that Donald Trump's solid primary performance is a dollar bullish risk factor. Do you think they're right?
Well, his solid primary performance does not spell what is going to be the outcome of this election and what's going to take place between now and election day. So I would lean off a little bit against that. That being said, my views are that a Donald Trump victory, however narrow, is probably at least partially priced into the US dollar. I think what's not priced is a Trump-led GOP landslide. That, to me, is a very dollar bullish scenario. But I think a constrained Trump victory, where the government is split, we're sort of there already. So I mean, feeding into my broad dollar view for the year, still looking at episodes of dollar weakness interspersed or with intermittent periods of dollar strength, and kind of a flattish profile for the year as a whole, unless from the political spectrum, the polls flip dramatically either way, like landslide versus, it's going to go to the Democratic side. But that's kind of where I am. I think the Trump victory, constrained, split government, is almost priced in. It's almost reflected.
I want to talk about your outlier risk, because you've whetted our appetite. It's Monday morning, Stephen. It's 5:11 a.m. in New York. You've had a lovely morning, a cup of tea, a bit of toast. You've had a very relaxed tune-in for this. So why not go for we'll go for the outlier risk. Come on, Gallo. So if it's a full-blown Trumponian risk, what does that do to risk in the world? I mean, there are some policies there that we know may be contentious in trade, in NATO, etc., to say the least. But extrapolate for us if it really was a full sweep by the Trump.
GOP landslide with Trump as the candidate, and
yeah.
Initially big dollar rally, but there's an argument to be made that into 2025, once this administration, this new government is seated, so to speak, there's a risk to be made that geopolitical risk actually subsides a bit. But it's very uncertain at this point. I would say that the more certain it looks as that Trump will not only be the nominee and he wins the presidency, there's a little bit of dollar strength left in that trade, but I think not as much as there was on December 31st.
Okay.
If it looks like there's going to be a GOP landslide, there's more dollar strength, and then we wait to see. But my base case now is that most of the materialization of geopolitical risk is going to be confined to 2025, because I think that in the run-up to the election, as long as the Trump risk factor is there, you may actually see some type of reduction in global geopolitical
Right.
risk because of the uncertainty.
The good news, Stephen, and maybe
that
bad
doesn't
news.
mean that there won't be vote.
Sounds
Sorry,
like
that doesn't mean that there won't.
Another year of kicking the risk can down the road, maybe, is what that sounds like.
That doesn't mean that there won't be. That does not mean that there won't be volatility spikes. There probably will be.